In this episode 8, we will learn about inverse fair value gaps. I will break down what an inverse fair value gap is, how to choose the right one, and frame your entries. So let's get straight into it. The first thing you need to understand is what a fair value gap actually is. A fair value gap is a 3-candlestick pattern, candle 1, candle 2, candle 3, where the wick of candle 1 and the wick of candle 3 do not overlap, leaving a gap in price. That gap represents an imbalance in delivery. If the imbalance is formed during a move lower, that is a bearish fair value gap. If the imbalance is formed during a move higher, that is a bullish fair value gap. Now let's talk about inversion fair value gaps. An inversion fair value gap occurs when a previously respected fair value gap is not respected anymore, and price closes aggressively through it. When we get a strong expansion candle that closes decisively beyond that fair value gap, it flips its role. What was previously resistance can now become support. What was previously support can now become resistance. So from that point, we can anticipate continuation in the new direction, either higher in a bullish trend or lower in a bearish trend. Now here is the mistake most people make when trading inversion fair value gaps. They do not look at higher time frame context. They do not understand swing points. And they are simply pattern trading. They see a sweep, they see an inversion, and they enter blindly. For example, you might see price take out a high, form an inversion, and you take the entry right there. But without higher time frame alignment, you can easily get stopped out because you are trading against the real structure. So what would this look like with proper time frame alignment? If you are going to trade inversion fair value gaps, you need to understand candle 2 and wick size. You are essentially trading candle 2 in the fractal sequence, and that means you need a candle that supports expansion. What does that mean? You need a small wick. For example, candle 2 sweeps the high of candle 1. That sweep takes important liquidity at a higher time frame key level. If candle 2 forms with a small wick, that supports expansion in the opposite direction. That tells you price did not waste too much range forming a large opposing wick. Then when you get the inversion fair value gap, you can anticipate continuation in that direction. So for a valid inversion setup within the fractal model, you want a sweep of candle 1's high or low, a small wick on candle 2, supporting expansion. Then the inversion fair value gap. If you want extra confluence, you can also look for SMT divergence between candle 1's high and candle 2's high. That alignment between liquidity, wick structure, and inversion is what creates a high probability setup. Now let's hop into TradingView and go over a few examples of this in real price action. So here we are in our first example. We are on Euro on the 15-minute chart. You can see we have a fair value gap right here. So the question is, what happens next? Price comes back and creates what looks like an inversion. But are we interested in this? No. Why not? Because we have to go back to what we discussed earlier. We need a candle that supports expansion. The previous candle does not support expansion. There was no proper sweep of a meaningful high, and there is no strong context behind this inversion. This is just consolidation. If we are looking for a short setup, what do we need? We need a sweep of a relevant high first. We need liquidity taken. Right now, that has not happened. So this inversion is not valid. Let's see if price takes out that previous high. Now we do take out the high. Good. That is step 1. Now do we create an inversion after that? No, we do not. So again, there is no valid setup here. We have the sweep, but no proper inversion afterward. This next candle does not really support expansion either. It does not have a large wick, but it also does not give us the displacement we want. It can act as drawn liquidity, but we would want to wait for a new candle open and a cleaner setup. Now we get a new candle open and we take out the previous candle's high. That is another sweep. So now we ask again, do we have an inversion with displacement? At this point, not yet. There is no clean fair value gap immediately after the sweep. and we do not get aggressive displacement lower. Instead, price makes a new high. Now this is where it becomes interesting. We sweep a short-term high above the previous 4-hour high. That is higher time frame liquidity, and right after that, we get an inversion fair value gap. Now we can mark that inversion. Let's see what happens next. We get an inversion and a change in the state of delivery. That is key. Now we have context. We are above the previous 4-hour high. We swept a short-term high. We get a change in state of delivery. We form an inversion fair value gap. We also have failure swings below and a candle with little to no wick supporting expansion. Now this inversion has proper context. When the next candle opens, we get continuation lower. That is the move we were waiting for. So to review, what makes this valid? We had a sweep of a higher time frame level. We had an inversion fair value gap after the sweep. We had a change in state of delivery. That alignment is what makes it tradable. If we also had SMT divergence between the prior highs, that would add even more confluence. In this case, we do not have it, but the setup is still valid due to structure and liquidity alignment. Now let's move on to another example. So here we are in our next example. You can see price has already made a strong reversal lower, running out the consolidation lows on the left. We have multiple candles of expansion to the downside. That tells us we may be transitioning into a new phase of price. Now, if we are going to look for an inversion setup here, what do we need? We need a sweep of the previous low, ideally a meaningful low. Even better if we have SMT confluence. After that sweep, we want to see an inversion fair value gap form with displacement. You can see we do get a sweep of that previous low right here. So step one is complete. Liquidity has been taken. Now the question becomes, do we get a clean inversion? If you look closely, there are actually multiple fair value gaps stacked in this area. In this situation, instead of treating them separately, I would treat them as one large imbalance zone. Now how does price react? It does not give us a clean, aggressive V-shaped reversal. Instead, price trades into the imbalance and begins to consolidate. It does not decisively close through it, but it also does not strongly reject and expand. This is where I personally avoid price. Even if price eventually moves higher from here, this is not meeting the requirements of my model. There is no sharp rejection. There is no strong displacement. There is no clear continuation structure forming. Instead, price is compressing and consolidating inside the imbalance. Many times in this type of scenario, price will run the highs of the consolidation just to grab liquidity and then continue lower. So even if it does pop higher temporarily, that does not make it high probability. So just to review, when I see this type of reaction, I am not interested. I want to see a clean sweep, a clear inversion, and strong displacement. If I do not get that V-shaped rejection and continuation structure, I avoid it. In this case, I would rather see another run of the lows and then a cleaner model form before looking for a move higher. Not every sweep plus inversion is tradable. Context and reaction matter. So here we are in our next example. We are on gold on the 3-minute chart, and we have the 30-minute candles displayed through the indicator for higher time frame context. First, what do we notice? We are in a bearish move and currently consolidating. So according to the phases of price model, I want to wait for the consolidation lows to be taken before looking for a move back to the highs. I am not interested in buying inside the range. I want liquidity taken first, so we wait for those consolidation lows to get swept. And there they go. The lows are taken out. Now that we have a sweep of the previous candle's low, we can begin thinking about a potential inversion to trade higher. But before jumping in, we need to analyze the candle structure. Do we have a small wick that supports expansion? No, we do not. This candle opens, trades higher first, and then expands lower. That is a bearish candle with a large opposing run. It does not open near the low, form a small wick, and then expand higher. So this candle does not support immediate expansion. If we are going to get a reversal here, I am not expecting it to be a strong expansion candle right away. I am expecting price to move back toward its opening price and form more of a reversal type structure. Now, where is our inversion? We have two fair value gaps stacked in this area. I would treat them together as one imbalance zone. Let's see how price reacts to it. You can see we get a strong close through that area. That is a clean inversion. Now in this situation, yes, I could look to trade on that close. But since the candle had a large opposing run and does not support expansion, I personally prefer to wait for the open of the next higher time frame candle. From there, I can either enter at the open of the next higher time frame candle, allow my stop loss to sit within that inverted fair value gap, and target the other side of the range or a fixed reward, such as 2 times risk. Or I can wait for a continuation entry that follows. And as price plays out, we do get continuation. Price reaches into an important level, closes above it, and continues higher. You can also use inversion in place of a traditional change in the state of delivery. That is a valid approach. You can trade the continuation or the reversal depending on your model. But the main lesson here is this. When we have a large opposing run inside candle 2, expansion usually waits for the next higher time frame candle. In this case, we had the sweep of the previous low, then the inversion. But since the candle did not support expansion due to its large opposing run, the higher probability approach was to wait for the open of the next higher time frame candle. And as you can see, we do get that move higher, and either entry approach would have worked. So to review, we had a sweep of the previous low. We had an inversion. The candle did not support expansion due to a large opposing run. So we waited for the next higher time frame candle to enter or for continuation. That is how you apply inversion fair value gaps with proper candle structure awareness. All right, so that wraps up inversion fair value gaps. The main thing you need to remember is that an inversion by itself is not enough. You need context. You need a sweep of liquidity. You need to understand candle structure and wick size. And most importantly, you need higher time frame alignment. Do not pattern trade this. Look at where price is in the overall structure. Look at whether candle 2 supports expansion. And understand when to wait for the next higher time frame candle instead of forcing the entry. If you practice this properly, inversions can become a very powerful tool inside your model. If this helped you, make sure you like the video, subscribe to the channel, and share it with someone serious about improving their trading. I will see you in the next one.